You know, getting a mortgage can feel like trying to find your way through a giant, complicated maze. But here's the thing. Built right into that maze is a protective shield. And these aren't just random rules for the sake of having rules. They are very specific protections designed to keep you, the borrower, safe. So let's break down exactly how that shield is built.
I mean, think about it. This is one of the biggest financial moves you'll ever make. So what's actually in place to stop lenders from using confusing language or maybe even unfair tactics? Well, the answer isn't just one single rule, but a whole system, a whole philosophy, designed to make sure everything is fair and above board.
And the best way to understand this system is to break it down into three core ideas, what we'll call the three pillars. First, we've got Pillar 1, which is all about guarding against risky loans. Then Pillar 2, which mandates total transparency. You have to know what you're getting into. And finally, Pillar 3, which is about upholding professional and data integrity. We're going to walk through each one.
Okay, so Pillar 1 is all about playing defense. How do these regulations spot and really neutralize loans that might be too risky or even predatory? Well, it all boils down to two key acronyms you absolutely have to know: HOEPA and HPML.
First up is HOEPA, which stands for the Home Ownership and Equity Protection Act. The easiest way to think about this is as a tripwire for the most expensive, potentially riskiest loans. If a loan's interest rate or its upfront fees or the penalty for paying it off early are way above the normal range, it gets flagged as a high-cost loan. And as soon as that happens, a completely different, much stricter set of rules kicks in. And just look at how tough these rules are. Once a loan gets that high-cost label, some of the most dangerous features are just banned. Things like those huge balloon payments that can sneak up on you at the end of the term? Nope, generally banned. Penalties for trying to pay your loan off early? Gone. The rules essentially strip out the most toxic parts of the loan to protect the borrower. It's a really powerful tool.
So that's HOEPA. But then you have HPML, a higher-priced mortgage loan. What's the difference? Well, it all comes down to the action that's taken. Where HOEPA prohibits risky stuff, HPML triggers extra requirements. For example, an HPML might require you to have an escrow account for your taxes and insurance for at least 5 years. So think of it like this. HOEPA's goal is to completely eradicate predatory terms, while HPML's job is to add extra layers of protection to loans that are just a bit more expensive than average.
So why does all this matter? For any professional in this field, your job, your critical job, is to identify these loans the second they cross that line into HOEPA or HPML territory. You've got to spot them early so you can apply all these mandatory protections and restrictions right from the get-go.
Okay, so if Pillar 1 is about stopping dangerous loan products, Pillar 2 is all about making sure every single borrower understands exactly what they're signing up for. This is the world of transparency, and it's pretty much governed by one giant rule: TRID. The official name is the TILA-RESPA Integrated Disclosure Rule, but everybody just knows it by its simple, powerful motto: know before you owe.
The entire TRID process, this whole transparency machine, officially kicks off the moment a lender has 6 specific pieces of information. It's the borrower's name, their income, their social security number, the property address, the estimated value of that property, and the loan amount they're after. As soon as you have all 6 of those items, the application is officially complete and a very, very important clock starts ticking.
And believe me, that clock is precise. From the second that application is considered complete, the lender has just 3 business days, that's it, to deliver what's called a loan estimate, or LE. That's the first look at all the numbers. Then, way at the other end of the process, at least 3 business days before the final closing, the borrower must receive the closing disclosure, or CD, which has all the final figures. And I want to be clear, these are not suggestions. They are hard, non-negotiable deadlines.
So you might be asking, why 2 different documents? Well, it's pretty brilliant, actually. The loan estimate is your shopping tool. It's the good faith estimate of all the costs, designed to help you compare offers from different lenders. The closing disclosure, on the other hand, is the final receipt. It shows the actual locked-in costs. And here's the genius part. The final disclosure is designed to look almost identical to the first one. This makes it super easy for a borrower to put them side by side and see exactly what, if anything, has changed. No more surprises at the closing table.
At the end of the day, this whole pillar, this entire TRID process is about one thing: consumer empowerment. It shifts the balance of power. For a loan originator, your role is crystal clear. Provide information that is accurate, transparent, and on time every single time. That is how you make the promise of know before you owe a reality.
All right, we've covered the loan itself and the disclosure process. Our third and final pillar is all about integrity. And this one focuses on the people involved and the data they handle. Specifically, how loan originators get paid and their massive responsibility to protect a borrower's most sensitive information. So let's start with compensation. The rule here is actually super straightforward. A mortgage loan originator can be paid a fixed percentage of the loan amount or just a flat fixed dollar amount. That's it. What is absolutely 100% not allowed is any kind of compensation that changes based on the loan's terms, like getting a bigger commission for a higher interest rate or for packing in extra fees.
And the reason for this is so important. The entire point is to prevent something called steering. The rule makes it impossible for an originator to get paid more for pushing a borrower into a more expensive loan. It removes that potential conflict of interest and keeps the focus where it should be, on the borrower's best interest.
Now, beyond just how they're paid, there are really strict rules about how professionals handle your data. You've got laws like FCRA and FACTA, which are all about your credit information and protecting you from identity theft. Then there's GLBA, which basically makes lenders the guardians of all your non-public personal information. And finally, you have HMDA, which promotes fair lending by requiring lenders to report data about who is applying for and receiving loans.
So when you zoom out and look at this third pillar, it really all boils down to a single word: trust. Following these rules isn't just about checking a legal box. It's the very foundation of the borrower-lender relationship. It's about proving that you are acting in their best interest and that you can be trusted as a guardian of their financial future.
Okay, so we've walked through all three pillars. Now let's tie them all together into one clear compliance takeaway.
Here it is, the whole framework in a nutshell. Pillar 1, guard against risky loans. That means identifying HOEPA and HPML products immediately. Pillar 2, mandate transparency. You have to deliver those TRID disclosures accurately and on time every time. And Pillar 3, uphold integrity. That means following compensation rules to the letter and protecting consumer data like it's your own. That's it. That's the shield.
And so, that brings us to the big final question. We've seen how this incredible shield of regulation is designed to protect consumers. But the critical ongoing challenge for the entire mortgage industry is this: how do we balance this vital protection with also ensuring that we provide broad, fair, and equitable access to credit for everyone? It's a delicate balancing act, and it's the question that continues to shape the future of lending.